All right, I'm getting the live set up and then we will get started here, Jeff.
Sounds good.
Oh, we've got Harlan Bauer in the house with us. Harlan is my good friend from Albany. He's awesome. Looks like we've got Alicia on here, Jacob, Janet. Hi, everyone. All right, I think we are streaming live. Give me just 1 second. I want to make sure we're going over there. Hi, Janet. Nice to see you. I just talked to you yesterday. All right, we are live. So we're going to get started. Tonight, we are talking about making your money work for you in business, how to use your business profits to plan for the long-term goals. Because let's face it, more often than not, our business is often our largest financial asset that we have. But what Jeff and I both see happen from very different angles in the financial world is that business owners are not maximizing that asset to not only plan for reduced tax strategies now, but also looking at how do we plan for income in retirement, but not necessarily just kicking the tax bill can down the road. So my name is Amanda Kendall. I am the owner and founder of Elevating Profits. We are a full service accounting firm. We focus on everything from payroll, bookkeeping, tax prep to tax planning and strategizing. And then Jeff, please introduce yourself.
Hi, my name's Jeff Kauffman. I'm with Summit Family Office Services. We are a registered investment advisory firm here in Seattle area, and glad to be here.
Awesome. Thanks for joining me. Jeff and I have been kind of talking behind the scenes for, a little over a month now putting this together.
Yeah.
So we're excited to finally be bringing it out. So let's take a look. So here's our faces. I'm the girl, he's the guy. All right, so let's just dive right in here. And guys, please pop your questions into the Q&A box as they come up, and we will take a look at those and make sure that we're addressing those. Harlan has a relative in Seattle area, Jeff. He just
nice
comments for us. So, all right, so when we are talking about your business being your best asset, there's several areas that we're looking at, but the first one we're going to talk about is generating current income. Whether that is actively marketing, doing sales, in order to have a business, you have to generate revenue. And so that is one of the areas that your business can be a very valuable asset to you, is the ways in which you generate income, how you set that up. If you have the ability in your business to set up any type of recurring revenue or residual income, obviously that's going to be an amazing thing to do, because that means that you work once and you get paid multiple times, which can be a great thing in business. So the next thing, which I'm going to kind of let Jeff talk about here, is planning for future income.
Right. So planning for future income starts with savings. So, different ways to save through IRAs, retirement plans, all of that.
All right, and then tax-free income opportunities. So this is something super exciting. So there are legal and legitimate tax strategies where you can have income coming into your household that is tax-free. This is amazing. There's lots of this. Some of these ways are through paying your minor children, which we're not going to dive a whole lot into, but we are going to touch on that here in a little bit. Doing some income shifting opportunities, all some very high level stuff that we're not going to dive a whole lot into, but we are going to touch on today. But anytime you have the opportunity to generate tax-free income, this is something you want to do, because tax-free income is better than taxable income. And then income shifting, I kind of just touched on that. Jeff, did you have anything you want to add on the tax-free income opportunities from your angle on it?
No, not right now. I think we'll dive more into that a little bit.
Okay. All right. So let's take a look here. All right. So in the business world, we have different entities. Different opportunities come from the type of entity that you choose in your business. So the first one we're going to talk about is a sole proprietor or a single member LLC with no election. So if you have this type of entity, you are filing on a Schedule C combined with your 1040 tax return. You do not have a separate business entity that is required to file a separate tax return. And so on that note, I'm going to let Jeff kind of dive into some of the retirement options that are available when you're set up under this type of structure.
Sure. So a couple of retirement plans that work for that are a solo 401k, and you can even do a solo 401k Roth with that. An IRA, just a standard IRA or a Roth IRA, and then even a SEP IRA would work for that as well. And we'll go a little bit more into what those are in a little bit.
Perfect. Now, I just want to ask you here, because this is something I've been doing a lot of digging into this since you and I first talked a month ago.
Mm-hmm.
And from here's my tax angle on this, and I want to have you add in your angle from a retirement planning perspective. But if you're planning and you're being proactive with this from a tax standpoint and being able to maximize the contribution amount, a solo 401k is almost always better than a SEP because of the amount that you can get into it. Is that correct?
Well, both of them have almost identical contribution limits. And so it's just how you get there. But a SEP is more on coming from the business side of the, I guess, the business is the one that's making the contribution, sorry. The solo 401k, the employer and the employee both contribute. So if you have a business that's making a lot of money and you're looking to reduce the money on your Schedule C for your business, then a SEP IRA would be the best way to go.
Gotcha. Okay, that makes total sense. Thank you for that. So from a tax strategy standpoint, this is probably the most limited entity to do some creative tax planning within. However, there still are some options to do that there. As a sole proprietorship or a single member LLC, you have the ability to hire your minor children in business, and their income is not subject to federal or state income tax. And typically, if you do it correctly, not subject to FICA either. So that is one way when I'm talking from my angle of tax-free income opportunities. This is one way to bring it in. I always joke with people when we're talking about this, and I'm like, well, you're either going to give your kids the money or you're going to make them earn it. And I like making them earn it. It does several things. It teaches them the concept and the value of a dollar and working for a dollar. But it also allows you to then create tax-free income coming into your house for money that you were most likely going to spend on their activities or give to them anyways. So that's one thing that specific to this entity type is a strategy that we kind of look at here. And then really just going back to what Jeff said of really looking at maximizing those retirement options when those are available to you and doing what you can there. So the second entity type we're going to talk about tonight is S corporations, partnerships, multi-member LLCs. These all, like, they're not identical, but for purposes of tonight, we're going to kind of lump them into the same bucket here for us. So with that, Jeff, go ahead and tell us about the options that open up at this level.
Sure. So on this level, again, you can still do a SEP IRA for you and your employees, or a simple IRA. And a simple IRA is a little bit different. So the SEP IRA is more where the employer puts the money into the account. On a simple, it almost works just like a 401k. So the employee contributes and then the employer puts a match in.
Awesome. And so on this, when the employer is matching, this is a tax deduction to the business, guys. So when you're in this situation, there's always some benefit to the business as well. And we're going to talk in a little bit about the difference of when you have employees and when you don't have employees and how that differs in some strategies you may want to look at here. From a tax strategy standpoint here, these types of entities open up several things that you can't utilize always at the individual sole proprietorship level. There's some different benefits here, a lot of income shifting opportunities here. You can still pay your kids this way, but you do have to set up a sole proprietor as a family management corporation. So there are some benefits here. Now, one of the questions I get asked the most often, and I actually just answered this question this morning on a Facebook Live for a private group, but the question is, when should I set up an LLC and when should I convert to an S corporation? Now, let me preface my answer to this. with the fact that you could ask 10 different accounting professionals and probably get 10 very different answers. So I'm not saying that my answer is solid gold, but I feel like it has solid research and logic behind it, and I'm going to share that with you. So from the standpoint of when do you want to set up an LLC, my honest answer is from day one. And there are multiple reasons that I recommend that. I actually did a YouTube video on this just a few weeks ago. If anybody wants that, drop it in the Q&A and I will make sure to get a link for that into the chat for you guys. But basically, one of the main benefits with an LLC that most people don't think of is the ability to really separate yourself just a little bit. Identity theft and identity fraud is at an all-time high right now, unfortunately, in various different manners. But getting an employer identification number for your business is probably the number one way that you can just put a little bit of a barrier between you and the rest of the world when it comes to protecting yourself from identity fraud and identity theft. So that's one reason. The other reason is a lot of businesses that are structured as a sole proprietorship filing on a Schedule C, they're highly targeted for audits. And so at this level, if you set up the LLC, one of the things the IRS looks for when hobby loss rules is something that comes into play here. And one of the things that the IRS is looking for when they're determining if you're going to fall under the hobby loss rules is whether or not you have an intent to make profit. Setting up that LLC is a major step in showing the IRS and the state government entities that you have an intent for profit, that you're not just dabbling and playing around to see what's going to happen. So that's one of the benefits there. Major thing is if you have an LLC in place, it's really easy to convert you over to an S corporation when it makes financial sense to do so. And there's no magic number for it making financial sense. For most people, we start looking at that once there's about $40,000 of profit in the business, because that's ideally where we can say, okay, the cost savings that you're going to realize from that compared to the additional cost of filing the extra return and the payroll costs and all those things, that's where it's going to start to even out. But let's say you're set up as a sole proprietor and it's now November and you're like, oh man, I made $40,000 profit. We need to convert to an S corporation. We can convert you starting today, but we can't make it retroactive. If you have the LLC, you can make it retroactive to the beginning of the year. So just a little side step note there on the LLC. All right, so talking retirement options, Jeff, I'm gonna let you dive into this one, but I wanna just really have you discuss the difference once you have employees and when you don't have employees, like how you wanna balance that out.
Sure. So with retirement options with employees, again, we go back to the solo 401k. If you're 401k, but we try and stay away from those a little bit, just from the standpoint that when you have a 401k, there's a lot of forms that you have to fill out and a lot of back testing and everything. So for a retirement plan that makes the most sense with employees would be a simple plan. And that is, again, it's like a 401k, the employees contribute and then the employer does a match. When you don't have employees, then the solo 401k can come into play. Same with the SEP. Now, the SEP you can also do with employees, but you have to, whatever percent that you're doing for one, you have to do for all. So I would say a SEP with employees would only make sense if you're making a lot of money and you're looking for ways to save. Otherwise, without employees, the SEP is probably the best way to go.
Now, one of the things from my angle that we often look at when we're sitting without employees, especially if we have a married couple and the spouse is maybe the primary breadwinner, is looking at what point does it make financial sense to maybe add the spouse to payroll, and maybe literally the only purpose behind that is to fund their retirement. At that point, a SEP is something that we could potentially look at if it makes financial sense for the business. But as soon as you have outside of family employees, if you want to max yours, you have to also max theirs, and that can get very expensive very quickly, correct?
Exactly. Yeah. So like with a SEP, for example, you can save up to $57,000, which is 20% of someone's salary up to 285,000. So, say you made 100,000 and then you paid your wife 50,000. If you were doing the 20%, you could save 20,000 for you and 10,000 for her. So, just as an example of what the numbers kind of look like. So and then the employer makes the contribution right away. It is into the account for the client, and then the company gets to write off that $30,000 as a contribution to their retirement plan. So it's actually a perk. It's not taxable to the employee, and it's a deduction for the business.
Yes. Awesome. I'm making a note here of something that I want to make sure. I don't think it's on one of our slides, but before we end, I want to make sure we talk about the timing of when they need to open these types of accounts.
Okay.
Let's see. All right. So this is an area that Jeff and I truly agree on, and it is that diversification is key. So you have essentially, and you guys have probably all heard this, we're not talking about anything that's not out there that you can't Google, but there's really 3 tax buckets. There's tax now, there is tax later, and there's tax free. And these are really the 3 buckets that you have. So when we're talking tax now, from a tax standpoint, that's basically the taxable income on your tax return. From a retirement standpoint, Jeff, what are things that they would be doing that would still be taxed now but be tax free later?
Well, so tax now, I always say, when you start to invest, I always have people open up an individual account, which is a taxable account, and then like an IRA or a SEP or something like that, that is taxable later. And the only reason I do that is because you don't want to put all your money into a retirement account. You do want to have something in a taxable account only if you have a need for that money, before you retire. Because if you take money out of your IRAs or your 401k, you're taxed right away on that money, and you're actually taxed at a penalty of 10% if you take it out before the required minimum distribution starts, which I think now just moved up to 72 from 69 and a half. So
I think you're right, but I don't want to say for sure.
I know, exactly.
It's been a year of so many changes. I'm like, was that this year, last year, or 5 years ago?
Yeah, right. Yeah, no, I think they're making the change, but again, it might have to go through Congress, and we know, how that is right now.
Yeah, nothing moves fast through there.
Yeah. So, tax now would be that individual account. Anything that you buy or sell in that account, you're going to pay a capital gains, and then it will be counted as income. The tax later is your IRAs and all that.
Okay. And so from a tax planning standpoint, when we're looking at this, if you're in a low income year, and your accounting professional recommends that you contribute to a traditional account that allows you to reduce your taxable income in this year and pay it later, I want you to look at them and ask them why. Because if you're in a low income tax bracket, the tax now bucket is a better option than what it may be later. I wish I had a crystal ball and I could tell you what's going on with taxes and everything, but I don't. And even with everything going on, like everything literally in the last, not even 24 hours at this point, like there could be some huge tax changes coming depending on the outcome of everything today. So there's no way to know, but anytime you are in a low income tax bracket, you want to fund Roths or anything that is going to be taxed now and not later, because there's a chance that may be the lowest you'll ever pay income on that. And so anytime that they're telling you to contribute to a traditional account when you're in a low income tax bracket, I want you to fight for yourself, and I want you to ask them why and where that information is coming from. Because if you're in a low income year, tax it now, tax free later. If you're in a high income year, doing tax later may make sense to reduce your tax bill and offset some of it this year. But if they're telling you just to contribute to a retirement account because it's going to save you on taxes, just know that every $1,000 you drop in does not save you $1,000 in tax. So.
Yep.
Let's hit on that tax-free bucket, Jeff, because I'm sure that's the one people are looking at and like drooling and being like, ooh, how do I get there?
Right. So the tax-free would be more like your Roth IRA or your Roth 401k. So that money goes in after you've already paid the tax. And then the money grows tax-free. And then when you actually withdraw that money, it is actually tax-free because you've already paid the tax on it. Whereas the other two or whatever, the tax later, that's going in pre-tax dollars. So you're getting the deduction now, but you're going to be paying taxes later.
Yep. So that tax-free bucket, I want to make sure I understand this correctly because I always feel like I get this like spaghettied in my head.
Mm-hmm.
So you contribute to a Roth, you pay the taxes now, but the growth on that is tax-free later, correct?
Exactly. Yep.
So that could be a huge benefit when we're talking about growth and return rates and stuff like that. And then the other tax-free bucket that you hear people talking about, which I truly believe should be part of your financial plan, but maybe not as large of a part as some people have made it out to be in the last several years, is that whole life insurance policy, because that also grows tax-free for you to pull out of down the road. Anything to add on that one, Jeff?
Not so much. I mainly just deal with, more on the investment side,
Okay.
and not so much on the insurance. But that is, I do have clients that do have whole life policies that were sold to them in prior people that for that particular reason.
Okay. All right. And then from an accounting standpoint, that tax-free bucket is literally just how do we generate tax-free income into your household, paying minor children, sometimes you can rent your home from your business and it's tax-free. And that's, again, a conversation for another day, but there's a lot of strategies that you can use here to really hit all three of these buckets. And true tax planning is going to kind of help you sit a little bit in all three of these buckets and balance that out for now and later.
Exactly.
This is my least favorite slide section, but we got to cover it. Consolidation and the importance of good records. So for just a brief moment here, we're going to go doom and gloom on you guys, and we're going to talk about a worst case scenario for a moment. So we all know what that worst case scenario is. What happens if something were to happen to you? How easily accessible are all of your records for all of these various things to your family? Do they have access to all your bank accounts? Do they even know where to look to find all of this information? And how will you make sure that they know where to look if they don't currently? And so I know in conversations with Jeff that he's actually dealt with this a couple times in the past. So I'm going to kind of let him take lead on this one and talk about some of his advice and tips around this.
Sure. So one of the things when I sit down with a new client is we put together a binder for them for their records, not only for their statements that they get from me, but also just to have. And in there is a page that we have them list all their bank statements, account numbers, everything like that. The other thing that I also do, especially if I would say you're in your 50s and you have kids that are in college or out of college around in that range, I would also recommend setting up, a power of attorney form. Only from the standpoint that you never know if something's going to happen to you. You get, you're in the hospital or something like that. That way they can go into a bank, be able to keep paying your bills and everything else for you. Because that happened to me with my mom. We had a power of attorney form, but she couldn't remember where she had it, and she was, had a stroke and everything. Luckily, we were able to get stuff done, but have a new power of attorney form drawn up. But because of that, it's very important to keep good records just in case something does happen to you.
Yep. And so I want to add to this, and I'm going to go on a little bit of a tangent here, mainly just because it's something that my family and I have been looking into. But I'm glad you brought up the power of attorney, because there's variations of power of attorney. So you have a medical power of attorney,
Mhm.
You have a financial power of attorney, and then you have like the living will that basically takes the decision of if you remain on life support away from any of your family having to make that decision for you. You just put it in there and it's done. But let's talk for a minute about your business and it being the biggest asset you have. And so I want you to think for a minute, like, I know for me, if something were to happen to me, like my husband would not have a clue what to do with my business at all. He wouldn't know how to communicate with the clients. He wouldn't know how to like get into any of the information I have. He wouldn't know where to start looking to try and make sure my clients were taken care of. He wouldn't know any of that. And we literally just had this conversation over the past couple of weeks as we're getting ready to set up our redo our wills and get our trust set up and things. And so basically, like one of the things that we're adding into our trust is some very clear instructions that if anything happens to me, there is a list of 3 to 5 people that it's like you go down this list in this order and you call these people and you let them know what happened. And these are colleagues of mine that I know would one either step in and help run the business and just take a paycheck until we could figure things out, or would offer to buy the business right then and there for fair value. So these are things that when you're looking at your business as being an asset, and especially if your plan is to work your business until you retire, or work until you retire and then have employees that continue to run it for you, and it really is a big part of your financial strategy in retirement, you need to make sure that you have some of these components in place. And one of the easiest ways to do that is a trust. This is not my area of expertise. This is not Jeff's area of expertise. It's total sidebar that I went on because he brought up power of attorneys. And honestly, just because it's something that my family is focusing on now, just making sure we have all of our ducks in a row. So if you need a recommendation or a referral to a good trust attorney, let me know and I can make sure I get that over to you. But I really think if your business is a big component of your retirement planning, that you need to have that piece in place and some steps to let somebody know beyond all the stuff Jeff just talked about, but the steps to let somebody know, here's what I need you to do with the business to make sure that it continues to function and produce revenue until we can get it sold.
Yep.
So, all right, off the doom and gloom, shake it off. We're getting happy again. All right, business strategies beyond retirement. So we're going to talk about a few things here, and Jeff and I are going to both chime in on a few of these. But your home office and vehicle expenses for your business, two of the most common overlooked expenses for small business owners. If you're a client of mine, it's not overlooked because we're monitoring that for you all the time. And every year at tax time, it's something I'm asking you like, hey, where's this? What's this? Where's this? How do we get this? We need this on here. So just know if you're in an S corporation, we have recently been reading up on some ways that we can do a home office in an S corporation. It is a little bit unique. It is a little bit outside of the box, completely legal. I've done a lot of research on it, but it's something that's fairly new in the tax code that we've been kind of reading up on and looking at utilizing. So for S Corp owners, know that you can't take a home office in the traditional sense, but there is a way for you to take it still. And again, if you're a client of mine in an S corporation, you're most likely going to be getting a call or an email about that very soon. Travel expenses, another big one. And something I want to tell you here is when you travel for work, a lot of times people are like, well, I'm going in for Monday, Tuesday, Wednesday, and then I'm going to stay Thursday, Friday for fun. And I'm like, great, but Thursday and Friday aren't tax deductible. Sorry, just Monday, Tuesday, Wednesday. So we need to take everything, divide it by 5, multiply by 3, take 3/5 of it all essentially, and that's how we're going to figure out what's deductible. Now, little secret of the trade here, if you're traveling and you are going to a conference on Monday, Tuesday, Wednesday, if you have a client in that area or a colleague in that area that you can plan to meet on Friday and you fly in on Friday instead, you conduct business on Friday, you conduct business Monday, Tuesday, Wednesday, and you have to be there over the weekend in order to conduct that business in both weeks. Now your entire trip's deductible, not the fun things you go do on the weekend, but all the travel, all the hotel costs, all the car rental costs, those types of things. So when you're traveling, just keep that in mind that if you can bookend end of week and beginning of the week with business stuff, then your weekend is still deductible for you as a business trip because you had to be there over the weekend. Hiring minor children and funding a Roth or paying for their activities. So I've already talked a little bit about hiring minor children. So Jeff, can you kind of chime in on funding a Roth for a minor child?
Sure. So we actually did this for my son when he turned 15. He got his first job, and Fidelity actually has a called a Roth IRA for kids. And what you do is you actually set it up under your name for the benefit of the child. And then they can use any type of money that they receive. It doesn't have to be, W-2 income. It can be from babysitting, mowing lawns, whatever they want to contribute. It just has to be documented as pretty well how they made their money.
It still has to qualify as earned income, like it can't be
Yeah.
gifts from the grandparents, correct?
Right. Exactly. So yeah, it has to be some type of earned income. But instead of, getting a W-2 from an employer, then they can at least do like chores around the house. They can do stuff like that, and you just document it. So that's what we ended up doing for my son. And then once they turn 18, then you file just a form. They take my name off, and then it goes strictly under his name.
That's awesome. Now I want you guys to think about this for a minute, because I'm looking at the list here and I can identify at least 3 of you that have children in your home. One of you I know has multiple children. So, and they're young. If you can start a Roth for your child now, let me preface this with, if you come to me and say you want to hire your 3 or 4-year-old in your business, I'm probably going to tell you you're crazy and no, we're not doing it, because there's really just not anything they can do. But normally starting at about 6 or 7, depending on the maturity level of the child, they can start doing simple things. My 8-year-old earns a weekly paycheck from me for shredding paper, dusting my office, vacuuming my office, and taking out my trash. I make him take out my trash too. But my office is in my home, but this is something I pay him to do because I can, and it basically funds him tax-free, and then we contribute to a Roth. But Jeff, I want you to chime in. So 8
Yep.
years old, if we were to fund his Roth with $100 a month, which is what he earns from me, so $1,200 a year at 8 years old, what is the worst case scenario? What is the potential value of that account being if he did that just for 1 year? What is the potential value of that account when he's 69?
Yeah. So, I mean, I would have to sit
We're
there
not
and
going to hold you to this.
yeah, no.
Making anything.
I do have a slide here that does explain a little bit. But say, going back to your example, say he did it from 8 to 28. Okay, so he saved $1,200 a year. He put in $24,000 in a 20-year time period, and then did nothing for 45 years, say 46 years. He would amass at an 8% annual growth rate. He would have about $471,000.
Boom, mic drop, guys, like that. Think about what better gift you can leave your kids for their
Right.
retirement. Like, I can't think of anything else that you can give your kids beyond a work ethic and a $400,000 retirement plan that they earned before they were 28.
Exactly. Now, say he didn't maybe he just put that money into a savings account and then didn't start until he was 47 and saved till he was 67. The same $24,000 only accumulates to $59,000. And that's the power of your compounding, because he's had so much longer period. He's had 46 years versus only 20 years of compound interest. So it's very important to save early and,
Yeah. And then it's very, very important, I believe, and Jeff, we haven't had this specific conversation, but I would say you probably agree. I think it is also very, very important from a young age to start talking to your children about money and teaching them about financial literacy and helping them understand, like, this is why we're doing this over here, and this is what it's going to give you. And then as they hit that 18, 19, 20, 21-year-old mark, maybe even up to like 25, until they like fully become like mental adults, telling them, like, don't touch this, don't touch this, don't touch this. Like, but if you just tell a kid that they have, $100,000 in an account, chances are, if you don't explain to them and instill that financial literacy in them, that they're just going to go and pull it out. They're going to have a major tax hit from it, potentially, all sorts of not fun things. So
And one of the things that I did early on was, everyone goes to the grocery store. So just start teaching them how to read, cost of items, or whatever. Now I have an 18-year-old and he'll go to the grocery store and he's like, Dad, I bought the bigger one, but the cost per unit is much cheaper. So he's learned how to like look at things now in a
I
different
love
light.
that. It's funny. My kids always joke. My 13-year-old does. My 8-year-old's starting to get there, but my 13-year-old jokes, and he's like, Mom, I'm probably the only 13-year-old in my school that understands that when you go to the store and you buy something for $5, that it's not just going to cost you $5.
Yep. There's a thing called
Like,
tax.
you know all about tax.
Yes.
So yeah, and Harlan chimed in on the box here. Schools don't teach kids anything about money. We have to be doing it at home. Like
Yes.
that's where it has to come from. So in our household, like we don't hide our finances from the kids. Like if it's a rough year, they know it's a rough year. If it's a great year, they know it's a great year, but it doesn't mean that we're going to go out and just throw money everywhere. Like we're still sticking to our budget and we're planning and we have goals and we communicate this with them very, very often. So I'm harping a little on the financial literacy with the kids here, but I think this was just a good time to drop that in and just kind of tell you, like, if you're going to do this, you also have to make sure your kids understand why and what, and explain it to them regularly and consistently as they start to grow up. So I've touched on this a little bit, having your S corporation rent your home. So there is some ways that there's actually two different strategies. You can have the home office option, and then you can actually have your S corporation rent your home for client events or staff meetings, things like those. Basically, you just need to find out what the fair market value is. There's some limitations on that. You can't go over 14 days in a year. But there is some ability to do that there. And so that's something that if you have customer appreciation events or staff meetings or those types of things, and you're comfortable hosting those in your home as an S corporation, it's a great opportunity to put tax-free income into the household because deductible to the business, not taxable to you as an individual. All right, accountable plans. I'm just going to briefly touch on this. But this is essentially if you are in an S corporation, specifically, not really for a sole proprietorship filing on a Schedule C, but more for an actual business entity, you can have accountable plans, which is basically where you can state like, okay, the business is going to pay for the cell phone, the business is going to pay for the car usage, maybe there's some health savings accounts in there. It's very encompassing, a lot that goes into that. And I'll be honest, it's so in depth that oftentimes I still have to go research to make sure that what we're trying to do with the client actually qualifies under that. But there are some options there that open up in a business entity to be able to do that. Hiring your spouse to backdoor certain benefits. Jeff and I kind of talked on this. Like if you're your only employee, you might want to look at hiring your spouse to be able to not only fund retirement for them that they wouldn't have otherwise, especially like in today's day and age, especially right now, while kids are at home all the time, we're seeing a lot of couples where one parent is more of a stay-at-home parent to handle the kids and the other parent's working full-time. So maybe being able to offset that loss of income that we're often seeing with that, with the ability to put them on payroll and fund their retirement with money that was just going to be sitting there and taxed anyways. There's also some options with health insurance and a few things like that there. So I've kind of touched on this, Jeff. I'm going to let you add anything you want on the hiring spouse to maximize the retirement contributions there.
I think we touched on that earlier, but it does make sense if your business has enough money to pay, you make enough money to pay an employee plus retirement, then of course it does make sense. Now, a spouse can always open up a regular IRA or a Roth IRA and do what they call, it's basically income based on their spouse, but it's called a spousal IRA. So they don't technically have to have money, earned money, because they're going after their spouse, but they can do that as well.
Oh, that's one I haven't dealt with much. Is there, other than the fact of not having to put them on payroll, are there really any real differences between the two?
Well, I mean, you're only allowed to save up to $6,000 a year in an IRA, a traditional IRA or a Roth IRA. So again, it comes down to the amount of money that your business is making, because if your business is very successful, then you would probably want to do a SEP so that you could maximize more than $6,000 into their IRA, into their SEP IRA.
Gotcha. Okay, good to know. Board of directors is another business strategy beyond retirement. If you, there's some things you need to be aware of here because it's not completely black and white. But if you have your spouse on your board of directors, does this mean that every fancy dinner you take them out to is tax deductible? No. But if you have a board meeting at a nice restaurant and you guys are legitimately discussing business and, you know, maybe your financials and the 5-year plan and actually talking about things business related, then yes, there is the possibility that date night could become board of director meeting and be tax deductible for you. So just something to look at there. There's definitely some legal angles that need to be reviewed in that and making sure it's correct. So it's not something that in my office we fully set up, but it is something that we do often mention if it makes financial sense, and sometimes it doesn't, and we just don't even bring it up because it just creates this like eagerness for it when it may not actually make financial sense. So that is what we had for you guys today. So really the gist of everything we talked about today is using your business as this asset that it truly is capable of being, but not letting it be your only asset. Basically, I feel like we're all taught when we start a business, like put all your money back into your business, put all your money back into your business. You need to grow, put all your money back into your business. And I think if you do that, Jeff's exemplified that in several things he stated tonight, and I've talked about it as well. But if you do that, I think you're really shooting yourself in the proverbial foot, in the sense that if something were to happen to your business and that was your only asset that you had, then what now?
Exactly.
So I think you
don't
definitely
have
need
to,
to.
you don't have to set up a big SEP IRA. You know, if you're putting a lot of your money back into your business, that's great. But at least then just open up an IRA and just get started. Practice saving $500 a month or whatever it is, and save up to that 6,000 to get started. And then as the business becomes successful, you can roll that IRA into a SEP IRA. You'll already have some savings, and then you'll be able to start saving more than the 6,000 a year.
Yep. And I'm glad you mentioned the monthly amount there, because I get asked this question quite often where people are like, well, I can't really afford much to put in it right now. Like I may be able to do a couple $100 a month. And I'm like, great, do a couple $100 a month. If you can't max it out, you don't have to max it out. It's just that option's there for you. But $200
Right.
today is way better than $200 next year.
Exactly. And actually, it is less. It's actually $375, because what you can do is you have the full year. So, for example, for 2020, you could still contribute money in 2021 up until April 15th for the 2020 year in your IRA.
I'm so glad you said that, because it reminded me that I wanted to touch on timing on the accounts.
Yep. So that is something big. Also with the SEP IRA and the simple IRA, or SEP IRA, I'm sorry. At the end of the year, so at the end of 2020, say you made 100,000, you don't have to put the $20,000 in January. You actually have until you file your taxes, including extensions. So you actually have until October of the following year, if that's when you do your taxes for your business or whatever, to contribute that $20,000. So it doesn't have to be a financial hit right away in January.
Yeah. And it's funny because I was sitting there and you said that, and I'm like, this is probably one of the only times any of my clients will ever hear me say, let's file an extension and wait until October to file, is if it makes financial sense, because we need that time frame to contribute. So
exactly.
With some of these accounts, I know there is certain timing on when the account has to be opened in order to contribute. So I know with a simple, we are past the window for anybody that wanted to open a simple, because you can't do that in November and December, correct?
Yeah, that's correct. Yeah, it's January to October.
Okay, and then, so if somebody wanted to do a SEP, when do they have to have that account opened by to be able to fund it for 2020?
Right. So that also had to be set up. It's the due date is the extensions of your business income tax return for that year. So again, you probably would have to wait until January to start setting that up. So you would have missed it for this year for 2020. But starting in 2021, you would be able to do that.
So we would have missed it for 2019, but for if
I
you
mean,
wanted,
2019, yeah. So for 2020, yeah, you could still do that. Yes.
okay. And then are there any restrictions? So if somebody were to go to into February and they're meeting with their tax professional, and their tax professional says, hey, it'd be a really good idea for you to contribute to a SEP and max it out, are they able at that time to open the account, or does the account have to be opened before the end of the calendar year?
You know, that's a good question. I actually don't know that. I'll have to get the answer to you, back to you.
I honestly, there's so many different dates and dollars out there, guys. Like, I think some people, Jeff, honestly just expect us to know all of this. And I'm like, hold on, let me look it up.
Right?
These numbers change on us every year. And especially this year with like the never ending tax season of 10 months straight. Like, some of these things, like, I'm like, I don't know if I'm thinking 2019 numbers, 2020 numbers, or 2021 numbers. So let me just confirm.
Yes, exactly.
All right, on the screen, guys, you have my email and Jeff's email. If you have any questions, please feel free to email either of us and ask those. I don't see any other questions in the Q&A here. I didn't see anything popping in the chat that I haven't addressed. So on that note, I'm going to tell everybody to go enjoy their evening. We finished a little bit earlier than anticipated, but that is not a bad thing, because I'm sure, like those of you on the East Coast, it's getting a little late, and here in my time, my stomach's starting to growl. And Jeff, the sun's probably just going down for you over on the West
Yes.
Coast.
Yes, it is.
We've got East Coast to West Coast tonight.
Right? Perfect.
Awesome. Well, thank you guys. I appreciate you jumping on. Again, reach out with any questions that you have. And I will be dropping this recording into YouTube. So if you want to catch it there, or you want to share it out with anybody, I'm not going to complain. Just YouTube Elevating Profits LLC, and you'll be able to find it there.
Great. Thank you again, Amanda.
Not a problem. Thank you, everybody. Have a great evening.
Good night, everybody.